The bear market for commodities from 2012 to 2016 resulted in massive underinvestment by the capital-constrained mining sector, setting the stage for a strong commodity cycle in the years ahead, as demand once again overtakes waning supply. In this video, I will outline some of the fundamentals driving commodity markets, highlight 3 key metals to watch, and discuss our overall outlook. The fundamental picture for commodities has actually improved in most cases from our July 2018 outlook. However, we now anticipate that ongoing macro concerns with respect to demand weakness related to a potential global economic slowdown could serve to overhang the commodities complex, albeit not equally, for the next 12 to 24 months. And although demand risks are clearly on the rise, we anticipate the next commodity bull cycle to be primarily driven by the supply side, following several years of underinvestment in new capacity. Macroeconomic concerns have continued to escalate on the back of growing global trade war fears stemming from President Trump's decision early this year to impose punitive tariffs on U.S. imports of steel and aluminum, followed by escalating tariffs on Chinese goods. Despite the trade war escalation, global manufacturing PMI indicators remain in positive territory, suggesting that demand for commodities remains relatively solid. But what does this mean for specific base metals? The base metals still appear to have the best fundamental outlook for 2019 to 20 among the commodities we cover. 2019 appears to represent the inflection point for copper, with the market anticipated to post its first meaningful deficit position since 2010, largely driven by another year of negligible mine supply growth. Looking ahead, we forecast the market to remain in a structural deficit over the 2020 to 22 periods. We anticipate the copper market to materially tighten up by 2020 to 21 as visible inventories are squeezed. Moreover, the current weakness is likely to extend the cycle as miners pause on starting new developments. We continue to forecast relatively large deficits in the nickel market ahead. However, with extremely high visible inventory still to work off, we do not anticipate the market to reach a state of physical tightness until early next decade, or about 1 to 2 years after copper. Longer term, nickel market fundamentals appear perhaps the brightest among the commodities we cover. Although zinc inventories are now approaching critically low levels following yet another large market deficit this year, the end of the multi-year zinc bull run appears within sight. Moreover, driven by relatively large anticipated supply growth over the 2019 to 21 periods, in the context of only meager demand growth, we forecast the zinc market to revert to balance next year, followed by modest surpluses thereafter. However, we forecast visible stocks to remain at very low levels for several more years, supporting an elevated price environment. In our view, only materially lower global demand growth could fundamentally change the outlook for these metals. The base metals are now all on the cyclical upswing, with zinc clearly the most advanced and likely near its peak. Copper is approximately 2 years behind, while nickel appears to have just turned the corner and is likely 3 to 4 years behind zinc due to the overhang of excess stocks. Despite our relatively bullish view on the fundamentals, we anticipate 2019 to be a more muted year for most commodity prices given the current negative macro overhang. Specifically, we now anticipate only modest upside in nickel, copper flat with downside risk in zinc. However, should the negative macro sentiment overhang lift, we anticipate that the current disconnect between fundamentals and commodity prices could close relatively quickly. You can find more thought-leading content from Scotiabank on our website, and you can also follow us on Twitter at ScotiabankGBM and on LinkedIn. I'm Orest Wowkodaw. Thanks for watching.